After studying this module, you shall be able to know the meaning of investment, learn the process of investment analysis, understand the elements of investment, analyze the relevance and the need for the investment analysis. We shall commence this module by studying the meaning of investment. The growth of the economy depends upon the capital formation process, which is dependent on the amount invested by the household sector, industries, private sector, etc. Therefore, every country try to provide a conducive environment to promote investment. An individual sacrifices his present consumption to generate savings, which they invest in various assets to generate income. So, investment refers to the employment of savings to earn income or return. Every investor expects a rate of return which is higher than the inflation rate. Investment can be defined as commitment of funds that is expected to generate additional money. It may also be described as a mechanism into which funds are placed with expectation of the higher returns than inflation. An investor who buy shares of a company expects dividend and capital appreciation of his investment. When he invests in debentures of a company, he expects a fixed interest stream during holding period. Similarly, when an individual purchases some immovable assets like house, earns capital gain when he transfers his assets, and also he can earn rental income. In all these cases, some features are basic, which have been stated as under. There is a commitment of funds, savings. There is an expectation of a higher earning than the inflation rate. There is always some risk involved in respect of return and the amount investment. Investment and speculation. In speculation, investment is made with an expectation of some return in form of capital profits resulting from the price change and the sale of the investment. It is relatively short-term investment. An investor has a relatively longer planning horizon. His holding period is usually at least 1 year and he is not willing to assume more than moderate risk. But in case of speculation, the risk level is high. Investment and gambling. The result of gambling is known more quickly. For example, the outcome of the roll of the dice is known almost immediately, which is not possible in case of speculation and investment. The objective behind gambling is fun, not income. But in case of both investment and speculation, the motive is to earn income and quick gains respectively. Now, we shall discuss the investment analysis or the decision process. In the context of investment, the term investment analysis is defined as the process of evaluating an investment for the profitability and risk. Here, the ultimate purpose is to measure how the given investment is good fit for a portfolio. Steps in investment analysis. Setting the amount of investable wealth along with the investment objectives. An investor decides the amount to be invested and his objectives of investment, knowledge of various investment alternatives. The amount to be invested may be the past saving or borrowed funds. The objective of the investor is to have recurring source of income or gain through capital appreciation. Analysis of different investment alternatives according to the needs of investors. After having decided about the amount to be invested along with the investment objectives, the investor is required to conduct analysis of the economy of the country, various industries and the companies operating within them. An investor refers to various factors such as growth rate in GDP, inflation rate, rate of interest, etc. to assess the state of economy. Finally, an investor chooses the best companies by making analysis various qualitative and quantitative factors. The values of securities are also assessed. For this purpose, current market price is compared with the prices obtained by discounting future earnings of the company. Constructing a portfolio of investment and determining the amount to be invested in each one. The next step is the allocation of the funds available for the investment in different securities, depending upon the risk-bearing capacity of the investors. If the investor is willing to take high risk, more of his funds will be put in the securities having higher risk and proportionately less amount is invested in the low risk securities. Periodic repetition of the above three steps to improve portfolio performance in the view of changing market conditions. This includes evaluation of risk and return of the portfolio. This is the last step in the investment analysis approach. The performance of the portfolio is compared with the market performance. If the investor has earned more than the other capital assets having same risk level, the investor would be satisfied. In case he has earned lesser than what could have been earned by investing in the same risk class assets, he must revise his portfolio. We shall now understand the elements of investment. For evaluating an investment avenue, the following elements are important: rate of return, risk, marketability, tax shelter, and convenience. Rate of return. A return may be from yield such as dividend, interest, or through capital appreciation. Capital appreciation is the difference between the purchase price and the sales price of the investment. The formula for calculation of the rate of return is as follows. Return is equal to maturity value minus initial value plus dividend upon initial investment value. For example, Mr. X purchased a share of Tata Company for 100 rupees in the year 2013-14. He received 10 rupees dividend each year and finally sold the share for rupees 105 in year 2014-15. His return would be 105 minus 100 plus 10 divided by 100. That is equal to 15%. Second, risk. The risk of an investment refers to variability of its rate of return. That is, how much an individual outcome deviates from the expected value. For example, if an investor expects to earn 18% return, but he actually earns 15%, then it means that he has failed to minimize his risk. The risk can be minimized by formulating portfolios. A simple measure of dispersion is the range of values, which is the difference between the highest and the lowest value. Other measures used in the finance are as follows. Variance. It is the means of the squares of the deviation of individual returns around their mean value. Standard deviation. It is square root of variance. Beta. This reflects the volatility of the return in response to the market swings. Third, marketability. An investment would be termed highly marketable or liquid if it can be transacted quickly. In other words, it should be readily converted into cash. The transaction cost is low. The price change between two successive transactions is negligible. The liquidity of a market may be judged in terms of depth, breadth, and resilience. Depth refers to the existence of the buyers as well as sellers at the current market price. Breadth implies the presence of buying as well as selling orders in substantial volume. Resilience means new orders emerge in response to the price changes. Generally, large and well-established companies enjoy high marketability of its shares, whereas small companies have low marketability in their formative years. High marketability is desirable characteristic and low marketability is of course an undesirable one. Fourth, tax shelter. The investor plans his investment considering his tax status as well as tax benefit provided by some investments. Tax benefits can be of the following three kinds. Initial tax benefits. It refers to the tax relief enjoyed at the time of making the investment. For example, an investment in public provident fund gets tax benefit under Section 80C of Income Tax Act. Second, continuing tax benefit. It is a tax shield associated with the periodic returns from the investment. For example, dividend paid by Indian companies is tax-free in the hands of recipient in India. Third, terminal tax benefit. A terminal tax benefit refers to the relief when an investment is realized or liquidated. For example, LTCG is exempt if the shares are sold through recognized stock exchange and where security transaction tax is paid. Fifth, convenience. It refers to the ease with which the investment can be made and looked after. The degree of convenience associated with the investment varies widely. For example, investment in a saving bank account can be made readily and it does not require any maintenance effort. But if investment is to be made by purchasing a house, there may be legal hassles and maintenance efforts are also required. Now, we will move on to discuss the investment avenues. A wide range of investment alternatives are available to the investors. These can be classified as follows. First, non-marketable financial assets. A big portion of financial assets is represented by the non-marketable financial assets like bank deposits, post office deposits, provident fund deposits. Second, equity shares. It carries ownership rights. It is often known as ownership capital. This means the shareholder has residual interest in income and wealth of the organization. It can be broadly classified into following broad categories: blue chip shares, growth shares, income shares, cyclical shares, speculative shares, preference shares. Third, bonds. It represents long-term debt instruments. The issuer of the bond promises to pay a stipulated stream of cash inflows during the period of the holding. These may be classified into following types: government securities, saving bonds, government agency securities, PSU bonds, debenture of private sector companies. Fourth, money market instruments. It represents those debt instruments which have maturity of less than 1 year at the time of issue. Some of the important money market instruments could be treasury bills, commercial papers, certificate of deposits. Fifth, mutual funds. Mutual funds represents pooled investment by small investors. This means instead of buying equity and debt directly, investors invest in their money in the mutual funds, which in turn invest in equity shares and fixed income securities. Broadly, mutual funds can be classified as equity schemes, debt schemes, and balanced schemes. Sixth, life insurance. Life insurance policies are also non-marketable financial assets, but these are considered as an investment. Insurance premium represent the sacrifice and the sum assured is considered as the benefit. The important types of the insurance policies in India are as follows: endowment insurance policy, money back policy, whole life policy, term insurance policy, pension plans. Seventh, real estate. For every investor, the most important asset in their portfolio is own residential house. The more affluent investor also invest in residential house, but they also invest in the following type of real estate: agricultural land, semi-urban land, commercial property. Eighth, precious objects. These items are generally small in size but highly valuable in monetary terms. These are also considered as an investment which can be readily converted into cash. For example, one can sell gold at any time as and when need arises. Some of the other precious items are silver and gold, precious stones, art objects. Ninth, financial derivatives. It is an instrument whose value is derived from value of the underlying asset. It may be viewed as a side bet on the asset. From the point of view of investor, the most important financial derivatives are options and future. All these investment avenues can be compared in terms of key elements or attributes of investment. A summary evaluation of various investment avenues is given below. Equity shares. Return on the current yield low. Return on capital appreciation high. Risk high. Marketability fairly high. Tax shelter high. Convenience high. Non-convertible debentures. The yield is high. Capital appreciation is negligible. Then is the risk is low. Marketability is average. Tax shelter is nil and convenience is high. Equity schemes. The current yield is low. Capital appreciation is high. Risk is high. Marketability is high. Tax shelter is high. Convenience is very high. Debt. The current yield is moderate. Capital appreciation is low. The risk is low. Then the marketability is high. The tax shelter has no tax on the dividend and the convenience is very high. Bank deposit. The current yield is moderate. The capital appreciation is nil. The risk is negligible. The tax shelter or the marketability is high. Then tax shelter is nil and convenience is very high. Public Provident Fund. The current yield is nil. The capital appreciation is moderate. The risk is nil. Marketability is average. Tax benefit is ATC benefit and convenience is high. Life insurance policy. The first factor is nil, then moderate, then is nil, then is average, tax benefit is nil and then convenience is high. Residential house, current benefit is moderate, capital appreciation is moderate, then the kind of the risk is again negligible, then the tax benefit is low, then tax benefit is less, marketability is high and the convenience is fair. Gold and silver, current appreciation is nil, capital appreciation is moderate, then is average, the other factor is also average, tax benefit is nil and convenience is average. We shall further understand the relevance of the investment analysis. Individuals as well as the institutions are increasingly making investments nowadays. The capital markets are also growing and it is evident by the fact that the number of mutual funds, private players in the insurance sector, real estate investment, etc. all are increasing regularly. Even the interest of small investors is increasing day by day. They are investing their money through mutual fund portfolios. Institutions also invest their employees' provident fund money and their idle funds. Sometimes corporate houses face short-term liquidity issues, and for this they park their funds in the money market instruments generally. So nowadays, study of investment is becoming more and more relevant. A careful and systematic investment helps investors to earn better returns in relation to the risk assumed. Investment analysis can provide a sound framework for both the management of wealth and increasing the wealth. It also helps the investors to find suggestion to some or all of the following issues. First, the types of financial assets available in the market. Second, the risk and the return relationship of these financial assets. Third, the difference between rate of return and the yield. Fourth, the use of diversification to reduce risk. Fifth, the use of fundamental and technical analysis in taking financial decisions. Sixth, selection of the mutual funds for investments. We shall now recapitulate what we have learned so far. The growth of the economy depends upon the capital formation process, which is dependent on the amount invested by the household sector, industries, private sector, etc. Therefore, every country tries to provide a conducive environment to promote investment. Investment and speculation. In speculation, investment is made with an expectation of some return in the form of capital profit, resulting from the price change and the sale of investment. It is relatively short-term investment. Investment analysis or decision process. In the context of investment, the term investment analysis is defined as the process of evaluating an investment for the profitability and risk. Relevance of investment analysis. Individuals as well as institutions are increasingly making investments nowadays. The capital markets are also growing, and it is evident by the fact that the number of mutual funds, private players in the insurance sector, real estate investment, etc. all are increasing regularly.